Today we're going to talk about how you can reduce your taxable income by up to $100,800 on your tax year 2015 tax return. A very common question that we receive from overseas taxpayers is, do I qualify for the foreign earned income exclusion? This is a great question because the exclusion can have a significant positive impact in reducing your federal income taxes, and depending on whether you maintain a residency in a state, whether voluntarily or involuntarily, because of your state tax code, it can also have a positive impact on your state tax return, depending on your state. This video will give you an overview of the foreign earned income exclusion and will be helpful to determine if you qualify for the foreign earned income exclusion. It's important to note that the IRS tax code is very complex, and there's many nuances to the foreign earned income exclusion that we simply don't have time to address in this video, but it will be addressed by a reputable tax professional with extensive experience in providing preparation services for overseas taxpayers. I do these videos because there's a lot of overseas taxpayers out there that haven't heard of the exclusion or struggle with how this works. Some of them may be a friend or a co-worker, so be a good friend and share this video with them so that they have an overview of how they can save money on their U.S. tax return as well. Time and time again, we hear from many taxpayers a very common and dangerous misconception. And that is, if you owe no tax as a result of the foreign earned income exclusion, then you don't need to file a tax return. That is not true. Tax is owed until the foreign earned income exclusion is claimed on the Form 2555 or Form 2555EZ. You must file a tax return even if there's no tax liability as a result of the exclusion. This can be a very dangerous misconception because if the IRS initiates activity to either inquire about the failure to file your return or even worse, collection activity to collect the tax, it's within the rights of the IRS, according to the tax code, to disallow the foreign earned income exclusion claim once you do file the tax return. In fact, any late return, even if there has been no IRS activity, can be disallowed by the IRS without the proper and required statements included on your tax return when making such a late exclusion. If this has happened to you, please let us know about your experience by commenting below. The first step to determine whether you can claim the foreign earned income exclusion is to determine whether you have any foreign earned income. Earned income is income received for services performed generally on behalf of an employer or for yourself as a self-employed person. The next step in qualification is that your tax home must be in a foreign country, and then you must qualify either under the Bona fide residence test or the physical presence test. The most common types of foreign earned income include salaries and wages, commissions, bonuses, professional fees, tips, and self-employment income. It's worth mentioning common types of income that are not foreign earned income, such as interest, dividends, capital gains, gambling winnings, alimony, Social Security benefits, pensions, and other retirement income. Let's dig into the determination of whether your tax home was in a foreign country. So what does that really mean? Your tax home is where you work permanently, regardless of whether you maintain a family home there or not. Your tax home is the place where you are permanently or indefinitely engaged to work as an employee or self-employed individual. If you expect to be away from home in a single location, and it does last for 1 year or less, it's temporary, unless the facts and circumstances indicate otherwise. If you're temporarily absent away from your tax home on business, you might be able to deduct your away from home expenses for travel, meals, etc. However, if you expect it to last for more than 1 year, it's indefinite. If your assignment is for an indefinite period, your new place of employment becomes your tax home, and you would not be able to deduct any of the travel-related expenses that you have in the general area of this new assignment. If you had no foreign earned income, or your tax home was not in a foreign country, then you don't qualify for the foreign earned income exclusion, and it can't be claimed on your return. If you had foreign earned income, and your tax home was in a foreign country, then you need to ask the question, were you a U.S. citizen? The reason for this is because only U.S. citizens and some U.S. resident aliens can make a claim under the bona fide residence test. The bona fide residence test is determined on an individual basis and is determined on a number of qualitative factors versus quantitative factors that collectively are used to determine qualification under the bona fide residence test. Common facts include your intention, the purpose of your trip, and the nature and length of your stay abroad. Some of the other factors that should be considered by your tax professional in order to make a qualification assessment include the nature of your housing, such as whether you lease or own your housing, or whether you reside in employer-provided housing. For additional information on the requirements that pertain to U.S. resident aliens in regards to bona fide residence test, you'll want to consult Publication 54 or your tax professional. If you answered yes to all the following questions, that you received foreign income, your tax home was in a foreign country, that you are a U.S. citizen, and that you are a bona fide resident in a foreign country, then generally you will qualify for the foreign earned income exclusion. In order to claim the exclusion, you must complete the Form 2555 or Form 2555EZ and attach it to your individual tax return. If you don't qualify under the bona fide residence test, the next option is to determine if you qualify under the physical presence test. You have to ask the question, were you physically present in a foreign country or countries for at least 330 full days during a consecutive 12-month period, in which some or all of the days in the consecutive 12-month period fall within the tax year. In other words, you must have spent 35 days or less in the U.S. during that 12-month consecutive period. Now, if you didn't meet either the bona fide residence test or the physical presence test, then you would not be able to claim the foreign earned income exclusion. If you still have questions or are struggling with the foreign earned income exclusion, please add your comments below. Chances are your comments or questions will be helpful to others, and we would like to help as many people overseas as possible, and we can respond with helpful feedback for you as well as many others. Please be a good friend and share this video so that they can save money on their U.S. taxes as well. If you need help determining whether you qualify for the foreign earned income exclusion, or would like to have a private one-on-one consultation with us, please feel free to contact us either at the Tax Samaritan website or email us directly at info@taxsamaritan.com. Thank you.